Welcome to my channel. I'm Scott, and if you want to catch my newest video, I post one every day. In this video, I am going to walk you through the process of valuing MGM stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. MGM Resorts is a hospitality and entertainment company with locations in Las Vegas, Massachusetts, Detroit, Mississippi, Maryland, and New Jersey. Its well-known spots are the Bellagio, Mandalay Bay, MGM Grand, and Park MGM. The company has a majority interest in MGM China Holdings, which owns the MGM Macau Resort and Casino. This company also owns 50% of City Center in Las Vegas, which features Aria Resort and Casino. It has a majority controlling interest in MGM Growth Properties, which is a real estate investment trust. The company began operations in 1987 as MGM Grand and became MGM Mirage in 2000 after acquiring Mirage Resorts. In the mid-2000s, growth of its non-gaming revenue began to outpace its gaming receipts, and demand for high-rise condos was surging. The company shifted focus from owning and operating resorts and casinos to developing and building real estate in the leisure and gaming industry, launching the massive City Center mixed-use project, which was at the time of its construction the world's largest construction site and ranks as one of the most expensive real estate projects in history. Let's get started with the model. This is a large cap company, 14.7 billion market cap. They're trading at $29.80 a share, and they have 494 million shares outstanding. Let's look at the financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. So you can see in the trailing 12 months, they did have negative free cash flow, but positive in the other years. Net income is the profit and loss on the income statement. It's revenue minus expenses. And they do have positive net income every single year. Revenue is the sales for the company, and that was growing nicely from 2017 to 2019, but then dropped in the trailing 12 months due to COVID. This is the company's income statement. The top line is the revenue, the sales. Below that is the cost of revenue. These are the expenses directly related to generating the revenue. Then the difference between those two numbers is their gross profit. So you can see that fell to $3.4 billion in the trailing 12 months. It did peak at $5.3 billion in 2019. You can see operating expenses. They did a great job at cutting them in 2019. But they didn't cut them more in the trailing 12 months. So they had really low operating income relative to 2019. But they did have higher operating income in the trailing 12 months relative to 2017 and 18. The company also has a good amount of debt on their books, so they have a pretty high interest payment on their debt. Then there's other income and expenses, which are usually impairments or investments. The bottom line of the income statement is their net income, and that was $2 billion in the trailing 12 months. Pretty similar to 2019 and 2017. It looks like in 2017 they had a $1.1 billion tax rebate. So we would need to look into their 10K why they had this tax rebate in 2017, but that's why their net income was so high that year relative to their pre-tax income. This is the company's statement of cash flows. The top line is operating cash flow. That's how much cash the company generates from its operational business. So you can see they lost $242 million in the trailing 12 months. But in prior years, they had lots of operating cash flow, $1.7 billion to $2.2 billion. Then you have capital expenditures, which are investments in property, plant, and equipment. And that was the lowest in the trailing 12 months. So their free cash flow is operating cash flow minus CapEx. So they had a big negative in the trailing 12 months. In 2017, 18, and 19, it looks like they issued the same amount of debt as they paid off, so they did not add to their debt load in those 3 years. But in the trailing 12 months, they added $3.3 billion of debt and paid down $2 billion. So they increased their debt load over $1 billion. That was to fund their operations because they had negative free cash flow. The most important part of any business is their operating cash flow. And this company does generate nice operating cash flow, except in the trailing 12 months. The way you calculate operating cash flow, you start with net income that was $1.8 billion. Then you have to add or subtract the non-cash items on the income statement. It looks like they passed through a $3.5 billion gain onto their income statement, but that was a non-cash item, so we have to subtract that out on the statement of cash flows. Then they passed through a $1.2 billion depreciation expense, so we have to add that back on the statement of cash flows. Deferred taxes of $655 million, and then some other items. So even though the company reported $1.8 billion of profit, they actually lost $242 million, mainly because they passed through this $3.5 billion operating gain. Because you need to remember, the income statement is accounting profit and loss. It's not actual cash. The statement of cash flows reports actual cash. You still need to look at the income statement because it could give you information for the future and also information from things they did in the past. But given the circumstances, I'm not surprised the company lost money in the trailing 12 months. Let's look at a capital structure. $12.5 billion of equity, $15.5 billion of debt. So they're 45% equity, 55% debt. And their WACC is 12.09%, and that's a discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated terminal value, which is all cash flows past year 4, that's $15.6 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $13.2 billion. We divide that by 494 million shares. And we get a calculated stock price of $27. They're trading at $30, so they're trading at an 11% premium. It's a sell according to the model. Simply Wall Street values the company at $63, so they're saying it's really undervalued. They're saying it's a strong buy. The stock was trading fairly steady for a few years in the low 30s. Then it dropped when coronavirus hit in March. Then it's come back almost to its all-time high. The company was paying a 15-cent dividend, then cut their dividend to 1/3 of a cent in June 2020. They're paying a 0.5% dividend yield. That's 53 basis points. Their payout ratio is 4%. That's annual dividend payment over net income. Since they have negative free cash flow, we can't look at the percentage of cash flow they pay out. If you invested $10,000 into this company 10 years ago and reinvested the dividends, you would have $19,000 today. If you did not reinvest the dividends, you'd also have about $19,000 today. If you invested $10,000 into this company in January 2011, you would have been down right off the bat for a couple years, probably below $6,000. But if you would have held on, you could have sold at about $20,000. But if you're still holding now, it's still not a terrible return on investment. It's about a 6.6% annual return. This company has a really high beta, 2.44, so the stock moves about 2.5 times the market. The stock has gone down 8% in the past 52 weeks, much worse than the S&P 500, which went up about 13.5%. The 52-week low was $6, the high was $34, and the stock is trading below its 50-day moving average, but above its 200-day moving average. This is a pretty liquid stock. Almost 10 million shares are traded each day. And of the 494 million shares outstanding, 431 million are on float. 2/3 of the shares are held by institutions, and almost 6% of the shares on float are shorted. The biggest shareholder is Interactive Corp at 12%, then Vanguard at 9%, then BlackRock, Corvex, and T. Rowe Price. Let's look at their financial ratios. The average PE in the market's 11.3, the median is 14.4. PE is stock price over earnings per share. To calculate earnings per share, that's net income over shares outstanding. They're at 7.5, so they're doing better than the median average. This means investors are paying $7.50 for $1 of earnings. Price to sales is stock price over sales per share. They're at 1.6, also better than the median average. Price to book is stock price over book value per share. They're at 1.2, better than the median and average. Interest coverage ratio is EBIT over interest expense. They can cover their interest payments 3 times. ROE is net income over equity. They're at 16%, much better than the median and average. Current ratio is current assets over current liabilities. They have a good current ratio at 1.3. They have current assets of $2.3 billion of cash and $1.4 billion of receivables. So the company does not seem to be well capitalized because they did have negative free cash flow, but they do have positive working capital of $800 million. So that's a wash. But they do have a dividend payment, although it's pretty small at $79 million. The best way to look at ratios to compare them to similar companies, I've done videos on Boyd Gaming, Caesars, Golden Entertainment, Las Vegas Sands, Vail Resorts, Penn National Gaming, Red Rock Casinos, and Wynn Resorts, all in the same industry as MGM. And if MGM has a number in red, they're worse than the average. If they have a number in green, they're better than the average. So they're a little worse in PE because the average is all skewed with all these negatives. But they do have a better price to sales, price to book, current ratio, ROE, because most of these companies are negative. They're doing better in debt. They're a little better market cap than the average company. And they're one of the few companies in this industry that still pays a dividend. So to summarize, I do have them trading at 11% premium. But this is a really big company. They also have a really high beta, so the stock could really jump up and down. So if you're in for a quick flip, you could make a lot of money. I'm not 100% on board with a long-term investment. I could see the value if you convince me, but for myself, I don't know if I'd feel comfortable. But they were generating strong free cash flow before the pandemic, and they have really good ratios, so I don't think it's too much of a risk. So let me know what you think. Give this video a like, subscribe, or comment below. Also, if you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.